October 2025, the Canadian housing market stands at a critical crossroads as the Canadian Real Estate Association, CREA, releases its most significantly revised forecast in nearly 2 decades. With projected sales of 473,093 properties in 2025, representing a 1.1% decline from 2024, an expected national average home price of $676,705. The landscape presents a stark departure from the optimistic predictions made just months earlier. This dramatic revision marks one of the largest adjustments between quarterly forecasts since the 2008 to 2009 financial crisis, signaling profound shifts in market dynamics driven by trade tensions, interest rate volatility, and unprecedented regional divergence across Canada's diverse housing markets. At the start of 2024, CREA forecast a recovery year for Canada's resale housing markets, fueled by pent-up demand and lower interest rates. By mid-fall 2024, the rebound appeared to be underway, with forecasts predicting national home sales would once again top the 500,000 mark in 2025, and the average price would return to the $700,000 range. However, the landscape shifted dramatically in early 2025. Tariff, chaos, and economic uncertainty returned many homebuyers back to the sidelines, taking particularly large bites out of activity in British Columbia and Ontario, while putting additional downward pressure on prices. The catalyst: a combination of U.S. trade policy uncertainty under the Trump administration, immigration policy changes in Canada, and persistent concerns about economic stability. The 25% tariff threat on Canadian goods sent shockwaves through manufacturing sectors, particularly affecting Ontario's industrial corridor and British Columbia's lumber industry. March 2025 emerged as a pivotal turning point. National home sales decreased by 4.8% on a month-over-month basis, continuing a trend observed over previous months. Compared to the market peak in November 2024, national sales activity plunged by 20%. Even more concerning, actual sales in March 2025 were 9.3% lower than in March 2024, marking the lowest March activity since 2009. The psychological impact was immediate. Buyers who had been preparing to enter the market during the traditional spring buying season suddenly retreated, adopting a wait-and-see approach as economic headlines grew increasingly alarming. The Bank of Canada has lowered its benchmark interest rate to 2.25% as of October 29, 2025, marking the 9th rate cut since June 2024 and moving the trend-setting rate 175 basis points lower than it sat prior to the beginning of that rate-cutting cycle. This aggressive easing represents one of the most significant monetary policy shifts in recent Canadian history. The overnight rate now sits at 2.5%, with the bank rate at 2.75% and the deposit rate at 2.45%. For context, the policy rate peaked at 5% in July 2023, the highest level since 2001. Traditionally, lower interest rates stimulate housing demand by reducing mortgage costs and improving affordability. Yet, the current market defies conventional economic theory. Several factors explain this paradox. 1. The renewal crisis. Approximately 60% of all outstanding mortgages are due to renew within the next 2 years. Many of these borrowers will renew for the first time since interest rates increased in 2022, which means most borrowers will likely see a significant increase in mortgage payments. Homeowners who secured mortgages at 2 to 3% rates in 2020 to 2021 face payment shocks of 25% or more upon renewal. 2. Affordability still stretched. Despite rate cuts, homes remain expensive relative to incomes. Buying an average house with a competitive mortgage rate and typical 25-year amortization would translate into a monthly mortgage payment of $2,880 initially, including $1,930 in interest costs. The median after-tax income for a Canadian family is $70,500 per year, around $5,880 per month, meaning mortgage expenses represent 49% of monthly income. 3. Economic uncertainty overrides rate relief. Bank of Canada Governor Tiff Macklem acknowledged that tariffs are weakening the Canadian economy, noting that tariffs are increasing trade friction with our biggest trading partner that has efficiency costs, which monetary policy can't undo. When job security feels uncertain, even cheaper borrowing costs won't convince buyers to make major purchases. Canada's two most expensive housing markets are experiencing the most significant corrections. Only British Columbia and Ontario are forecast to see declines in average home prices in 2025. But the combination of those declines, along with fewer sales in those expensive provinces, was enough to offset price gains in the range of 4% to 8% in most other provinces. Vancouver's descent. The average selling price of a home in Vancouver decreased by 3.2% year-over-year to $1,142,100 in September 2025. The average selling price of a single-family home decreased by 4% to $1,935,800. Townhouses fell 2.7% to $1,069,800, and condos dropped 4.4% to $728,800. The Vancouver market presents a textbook case of oversupply meeting weakened demand. Detached house prices have broken below the January 2024 floor of $1.94 million. Since the spring 2022 peak, Vancouver house prices have resembled a white-knuckle roller coaster ride, with values swinging tens of thousands of dollars up and down. Inventory levels paint a stark picture. The number of listings increased by 19% from 2,740 in 2024 to 3,261 in 2025. For detached properties between January and July, while the number of sales decreased by 20.9% from 2,784 to 2,201. Perhaps most concerning, no new presale projects launched in January or August 2025, suggesting developers have lost confidence in the market's near-term prospects. Toronto's correction deepens. Toronto's market correction has proven even more severe than Vancouver's in certain segments. Condo prices fell by 1.3% in April from March to the lowest level since August 2021 and are down 4.4% year-over-year since the peak in March 2022. Prices have dropped by 12.1%. In the city of Toronto, where sales were down 23% year-over-year in March, the average home price fell 3.1% on an annual basis. The decrease was driven by a 3.9% year-over-year depreciation in condominiums to $686,700 and a lesser 0.8% decline for single-family homes to $1,693,200. The condo market deserves special attention. Years of aggressive development created a supply glut just as demand weakened. The Toronto Regional Real Estate Board reports condominium apartment sales in the first quarter of 2025 amounted to 3,794 in the Greater Toronto Area, down 21.7% compared to 2024. While coastal markets struggle, prairie provinces continue showing strength. Alberta, Saskatchewan, and Manitoba are experiencing robust price growth driven by affordability advantage. Homes remain reasonably priced relative to incomes. Energy sector strength. Despite tariff concerns, oil and gas employment remains stable. Interprovincial migration. Families priced out of Toronto and Vancouver are relocating. Population growth, immigration continues flowing to these regions. Calgary and Edmonton have emerged as particular bright spots, with prices appreciating between 4 to 8% annually despite the national slowdown. Quebec City naturally has the strongest price outlook, with Royal LePage expecting prices to appreciate by 11% in the fourth quarter of 2025 compared to the same quarter last year. What explains Quebec's resilience? Quebec City is a city of services, made up largely of public servants. As long as there are no concrete job losses, there is no collective stress that would slow down purchasing decisions, according to industry experts. Montreal also continues outperforming national averages, benefiting from its unique position as Canada's most affordable major city with strong employment fundamentals. In 2026, national home sales are forecast to rebound by 7.7% to 509,479, the highest level for activity since 2021, though still well below that peak and slightly under the 10-year average. The national average home price is forecast to increase by 3.2% from 2025 to $698,622 in 2026. This would mark the sixth straight year where the national average home price has hovered around the $700,000 range. Several factors support the case for 2026 recovery. 1. Pent-up demand. With 3 years of pent-up demand still out there and more normal interest rates finally here. The forecast continues to be for further upward momentum in home sales over the final quarter of the year and into 2026, according to CREA economists. 2. Demographics. Canada's population continues growing, creating underlying housing demand regardless of short-term economic volatility. 3. Rate stability. The overnight rate has reached the lower end of the bank's neutral range of 2.25% to 3.25%, meaning any future cuts will be considered extra stimulative and could put upward pressure on inflation. This suggests rates have stabilized near their likely floor. 4. Delayed spring market. CREA senior economist Sean Cathcart suggested that despite a chaotic start to the year, the latest data indicates the housing market rebound originally forecast for 2025 may have only been delayed by a few months. However, several clouds loom over the 2026 forecast. Trade war escalation. U.S. President Donald Trump's latest 35% tariff threat could trigger deeper economic disruption than currently anticipated. Mortgage renewal wave. The peak of mortgage renewals continues through 2026, potentially constraining consumer spending and housing demand. Government transition uncertainty. Canada faces political transition, with housing policy likely evolving under new leadership. Policy changes could support or hinder market recovery depending on their nature. Affordability crisis persists, even with modest price declines. Homes remain out of reach for many Canadian families without substantial family financial support. It's important to reiterate that all forecasts are still subject to higher than normal levels of uncertainty, though maybe less now than in the first half of 2025. Canada's housing market stands at an inflection point. The speculative frenzy of 2020 to 2022 has definitively ended, replaced by a more sobering reality of regional divergence, affordability challenges, and economic uncertainty. Since March 2025, home sales activity has been on a steady upward climb, suggesting the long-anticipated return of buyers into the market was likely only delayed. The next quarterly update, scheduled for January 15, 2026, will provide crucial insights into whether the projected 2026 recovery materializes or if further revisions become necessary. For now, caution and flexibility should guide decisions on both sides of transactions. What's certain is that Canadian housing has entered a new era. The assumptions that guided the market for the past 15 years, perpetual price appreciation, falling interest rates, unconstrained immigration, no longer apply. Successful navigation of this new reality requires abandoning old playbooks and embracing a more nuanced, locally focused, and realistic approach to one of Canada's most important markets. The question isn't whether the market will recover, it will. The question is what form that recovery takes, which regions lead it, and whether lessons learned from recent volatility create a more sustainable housing market for all Canadians. Only time and the data from CREA's ongoing quarterly updates will tell